Welcome back to Global Macro Pulse. It is Friday, February 13th, 2026. And if you are sitting at your desk this morning staring at your terminal, you you might be forgiven for thinking that your screens are broken. Or perhaps that we have slipped into some kind of multiverse scenario where two completely different timelines are, well, playing out at the same time. Because on your left screen, let's just call it the Wall Street timeline, you have U.S. equity markets pricing in a Goldilocks soft landing with a side of absolute euphoria. The S&P is behaving as if the world is a garden party. But then you shift your eyes to the right screen. You look at the geopolitical risk premium, you look at the commodity volatility. That board is lighting up like a Christmas tree in a thunderstorm. We are witnessing a genuine structural bifurcation in the global order today.
It is the definition of cognitive dissonance, but, mapped directly onto asset prices. I've been staring at the VIX, the equity volatility index, all morning, and it is practically comatose. I mean, it's asleep at the wheel, trading like we are back in 2017. But then I toggle over to the volatility skew in commodities, specifically energy and strategic metals. And it is screaming. It's what looks like a 4 sigma event in the options market. The premium you have to pay for upside calls on oil or palladium right now suggests that the people who actually move physical goods around the world are, well, they're terrified.
That is the disconnect. That is the paradigm shift we're talking about. We have spent the last, 3 years obsessing over a single question. Can the Federal Reserve stick the landing? Can they bring inflation down without crushing the economy? And just as we get data suggesting they might actually pull off this miracle, the geopolitical architecture, the actual physical security of the trade routes and supply chains that allow the economy to function is deteriorating at a pace we haven't seen since the early 2020s, or perhaps even the 1970s. We have a situation where U.S. inflation data is signaling return to normalcy, while at the very same time, the State Department and the Pentagon are signaling imminent conflict.
And we're going to get into the hard numbers on that dissonance right now. Because the divergence is not just a vibe or a feeling, it is mathematically observable in the spreads. We have a fresh CPI print out of Washington that looks incredibly dovish on the surface. I mean, headline numbers that equity bulls are just drooling over. But in the same breath, we have a massive volatility spike in palladium and oil that completely, and I mean completely, contradicts the whole soft landing narrative. You can't have a soft landing if the landing gear, the supply chain, is being blown off.
Precisely. So here's the roadmap for today's deep dive. We are going to start by unpacking that U.S. inflation print headline CPI hitting a 5-year low, and I really want to challenge whether that number is real or if it's a mirage created by base effects. Then we're going to contrast that with the absolute shock hitting the metals market, a 133% tariff on Russian palladium. We need to talk about the chemistry and the industrial reliance there because this isn't just about jewelry, it's about whether you can even build a car in 2027.
Right. And then we have to look at the war premium. We have reports of a second U.S. carrier group deploying to the Middle East, while simultaneously we have talks scheduled in Geneva for Ukraine. It is a very, very mixed signal, but the bond market is sniffing out something specific.
From there, we will pivot to the Asian theater, specifically this new nationalism coming out of Tokyo under Prime Minister Takaichi and how that is colliding with a liquidity trap in China that looks increasingly like a full-blown balance sheet recession.
And finally, we are going to look for the alpha, because while the giants are fighting, there is a clear volume divergence happening in India and ASEAN, specifically Malaysia and Indonesia, that smart money is starting to chase. This is where the physical growth is actually happening.
Let's get into it. Segment 1, the view from Washington and New York.
Right, so let's look at the data that hit the wires this morning, Eastern Time. The Bureau of Labor Statistics released the January CPI. Headline CPI came in at 2.4%. Now, that is the lowest reading we have seen since May of 2025. Core CPI, so ex food and energy, is sitting at 2.5%, which is a fresh 5-year low.
So on the surface, that is a victory lap for the Federal Reserve. You look at that number and you say, mission accomplished. The inflation dragon is slain. The narrative machine is going to run with this all weekend. Inflation is dead. Long live the bull market.
Oh, absolutely. The bond market certainly thinks so. If you look at the swaps market right now, traders are pricing in an 80% probability of a rate cut by June 2026. The 2-year yield, which is, the most sensitive to Fed policy, it dropped 15 basis points immediately after the print. The market is effectively bullying the Fed to cut. They're looking at 2.4% and saying, if you don't cut now, you're tightening into a slowdown.
But hold on a second. I want to play the skeptic here. I want to challenge this narrative hard. We are calling this the inflation mirage for a reason. Yes, the headline number is 2.4%, but let's look under the hood. What actually drove it down? Was it a broad-based decline in prices, or was it, specific volatile components?
That's the catch, isn't it? If you decompose the basket, a huge chunk of this disinflation is coming from used vehicles and apparel. Used cars are down 4% month over month. That's a massive drag on the headline. But you look at services, look at insurance, look at shelter. Owner's equivalent rent, OER, is still sticky at 3.8% annualized. That is not dead inflation. That is structural stickiness.
Exactly. And this ignores the elephant in the room, fiscal dominance. We have a government in D.C. that is still running massive deficits. We are talking 6 to 7% of GDP during what is supposedly peace and prosperity. When the Treasury is issuing that much debt, and now we are layering on a trade war that is inflationary by definition, can the Fed really cut rates without just reigniting the fire?
That is the trap. The Fed wants to cut. The data, if you squint at the headline, says they can cut. But the liquidity cycle is being distorted. You have the Treasury pumping money into the economy via the deficit, which fights against the Fed's attempt to cool things down. And now you add the supply shocks. You can't just look at the price of a basket of consumer goods and ignore the structural costs being imposed on the supply chain upstream. And that brings us to the real story of the morning, the Department of Commerce.
This is huge, and it feels like it got lost in the shuffle. While everyone was watching CPI and cheering for cheaper used cars, the Department of Commerce in Washington preliminarily supported a 133% anti-dumping duty on Russian palladium. I need us to really stop and unpack what this means. This isn't just a tariff on vodka or caviar. Palladium is. It's industrial blood.
Absolutely. Let's get technical for a second. Palladium is a platinum group metal, a PGM. Its primary use, we're talking about 80% of global demand, is in catalytic converters for gasoline and hybrid engines. It scrubs the bad stuff out of the exhaust. Now, here's the geography problem. Russia produces roughly 40% of the world's newly mined palladium. 40%. You slap a 133% tariff on that, and you aren't just taxing a commodity, you are effectively banning it from the U.S. supply chain.
Right. And the immediate counter-argument you always hear is, well, we can just source it from somewhere else, but can we? Who's the other big producer?
South Africa. They produce about 38 to 40%, but here's the problem with South Africa right now. The power grid. Eskom, the state utility, is still struggling with load shedding. Deep-level mining requires immense amounts of electricity. You can't just flip a switch and double production in South Africa when they can barely keep the lights on in Johannesburg. So you have taken 40% of the supply from Russia off the table with a price-prohibitive tariff, and the alternative supplier is constrained by infrastructure. That is a recipe for a parabolic price spike.
It is weaponization, pure and simple. This is the U.S. government using the tariff code to strangle the Russian economy further, to cut off revenue for their war effort. I get the strategic logic. But the blowback on U.S. and allied industry is immediate. You cannot hedge a 133% overnight cost increase easily.
And the market sniffed it out instantly. We saw a massive divergence in the metals complex this morning. Gold and silver actually had a flash crash earlier in the session, likely liquidity-driven or algorithmically triggered by the CPI print initially. But palladium and platinum, they're bid only. The spread between the spot price and the June futures contract just blew out. Backwardation is setting in.
Okay, explain backwardation for the listeners who might not trade commodities daily. What's that signal?
Right. So backwardation is when the spot price, the price to get the metal right now, is higher than the future price. It screams shortage. It means manufacturers are panicking. They don't care about the price in 6 months. They need the metal today to keep the assembly line running. This creates a systemic risk for the auto manufacturers. Ford, GM, Toyota, they are all pivoting to hybrids right now because pure EV demand softened. And hybrids use more palladium than traditional gas cars because the engine turns on and off frequently, so the catalytic converter needs to work harder to stay hot.
So the auto strategy pivots to hybrids, which drives up palladium demand right at the exact moment the U.S. government effectively blocks 40% of the world's supply. This feeds right back into that fiscal dominance thesis, doesn't it? The government is creating inflationary shocks via trade policy, fighting the deflationary trend of the consumer economy. How does the Fed even model that?
They can't. It's an exogenous shock. It's totally outside their models. If costs for autos soar because of palladium, that feeds back into PPI, the producer price index, and eventually back into CPI. So the 2.4% print today might just be the bottom. We might be looking back at February 2026 as the low point of the cycle before the second wave of inflation hits, driven not by demand, but by broken supply chains.
Which brings us to the reason why these tariffs and tensions are ramping up. We need to talk about the geopolitical black swan that's just hovering over the Middle East. It's all related. The tariffs are part of a broader economic warfare strategy, but the kinetic warfare risk is escalating.
You know, reports coming out of Washington regarding Iran are,
Yeah, they're specific.
and that is what worries me. Usually you hear vague chatter, right? All options on the table.
Yeah.
We aren't hearing vague threats today. We are hearing reports from defense correspondents that the Trump administration is preparing for a military campaign that could last weeks.
Weeks. That's the key word. That is not a surgical strike. That is not, we hit a radar site and go home. That is a sustained air campaign. And the confirmation signal for me isn't the rhetoric, it's the hardware. We have confirmation of a second aircraft carrier deployment to the region. You don't park 2 carrier strike groups. That's what, 10,000 sailors, 150 aircraft, and a dozen escort destroyers in the Persian Gulf just for a photo op.
No, you do that to establish air superiority and a theater-wide missile defense umbrella. You do that if you expect incoming fire. From a data perspective, look at the energy markets. Oil is bid, it's trading up, but it's not panicking yet. Brent is sitting at, what, $88? The market is pricing this as posturing.
Yeah.
But if you look deeper, look at the tanker charts. The insurance premiums for shipping through the Strait of Hormuz are ticking up aggressively. Lloyd's of London is pricing in risk that the equity market is just completely ignoring.
The market is underpricing the energy shock. If the U.S. targets Iranian nuclear infrastructure, or, as the reports suggest, state infrastructure, Iran's retaliation won't be asymmetrical warfare in the shadows. It won't just be proxies, it will be kinetic. And U.S. officials are admitting they expect a cycle of retaliation.
That is the tail risk. If we get into a tit-for-tat kinetic exchange that closes the Strait of Hormuz even for a few days, the oil basis blows out. We're talking about a volatility skew in crude options that could wipe out anyone who's shorting volatility right now. I'm looking at the call skew for April Brent crude. The $100 calls and $110 calls are trading at massive premiums compared to the puts. The smart money, the commodity trading advisors, the physical hedgers, they're buying insurance against a spike to $120 or $130. They aren't worried about a recession dropping oil to $60. They are terrified of a blockade spiking it to $150.
And it's not just the Middle East. The board is full of red lights. Let's pivot to Europe for a moment. We have this Geneva meeting scheduled for February 17th and 18th. U.S., Russia, Ukraine.
Right, the talks in Geneva, CET time.
And on paper, the headline readers see peace talks and they think, okay, risk off, the war ends. But look at the context. Look at the leverage being applied. President Trump is pressuring the Ukrainian president to act, which likely means make concessions or face aid cuts. But simultaneously, he's hitting Russia with that palladium tariff we just discussed. It feels less like a peace summit and more like a carrot and stick ultimatum.
The European markets are incredibly confused by this. You look at the DAX in Germany or the CAC 40 in France today, and they are trading completely sideways. No volume, the bid-ask spreads are widening, everyone is just waiting to see if Geneva is a de-escalation or if it's a setup for a harder push. Because if the talks fail, if Putin rejects the ultimatum, or if Ukraine refuses to concede territory, the escalation ladder goes up. And if that happens at the same time the Middle East flares up, well, that 80% chance of a rate cut just evaporates. You can't cut rates when oil is at $120 and supply chains are broken.
It's the convergence of risks. That's what makes this period so dangerous. You have independent variables, Iran, Ukraine, Palladium, that are all starting to correlate. And while the West is wrestling with these kinetic threats, the economic warfare in Asia is taking a very different, very nationalist turn. Let's move our focus to Tokyo and Beijing.
The situation in Tokyo is fascinating, and honestly, it's not getting enough coverage in the U.S. press. We have seen the rise of Prime Minister Takaichi. She isn't a placeholder. She is ideologically driven.
She is chasing Abe's dream, but on steroids. Constitutional revision, a stronger military, a Japan that says no. We've discussed her manifesto before, but now we are seeing it in practice. The arrest of that Chinese fishing boat captain this week, that wasn't an accident.
No, that is a classic escalation signal. In the past decade, the Japanese Coast Guard would typically use water cannons, push the boat back into international waters, and then file a diplomatic protest. Standard operating procedure. Arresting the captain, putting him in handcuffs, and charging him under Japanese law.
Yeah.
That is a legal and diplomatic statement. It asserts sovereignty over the disputed waters in a way that forces China to respond.
And the markets are watching the yen. The yen is the pressure valve for all of this. Takaichi wants fiscal expansion. She wants to spend huge amounts of money to rebuild the military and stimulate the domestic economy. But you have these inflation fears looming over Japanese government bonds, the JGBs.
Exactly. This is where the macro gets tricky. The yen carry trade is wobbling. For our listeners, the carry trade is borrowing in yen, where rates are super low, and buying assets in dollars or euros, where yields are higher. It funds a huge amount of global speculation. But if Takaichi pushes too much fiscal stimulus, inflation in Japan spikes. The Bank of Japan, the BOJ, would then be forced to hike rates aggressively to defend the currency and stop inflation. And if Japanese rates go up, the carry trade unwinds. That liquidity gets sucked out of global markets instantly. We are seeing JGB yields creep up today because investors are nervous that the BOJ is losing control of the yield curve.
So Japan is flirting with inflation and nationalism, and then you look across the water to Beijing, and the dynamic is the exact opposite. They aren't fighting inflation, they are fighting a deflationary collapse.
The People's Bank of China, the PBOC, just did a massive injection. We are seeing the numbers from Beijing this morning. A net injection of 380 billion yuan via 7-day reverse repos. The rate is holding at 1.40%.
380 billion yuan. That is roughly 50 billion US dollars. That is a lot of liquidity sloshing around for a single operation.
It is desperation. And let's explain what a reverse repo is here. The central bank buys securities from commercial banks with an agreement to sell them back later. Essentially, it is just shoving cash into the bank's hands. Here, take this money, please lend it. But the problem is the banks are taking the cash and they're just sitting on it. Or buying government bonds. They aren't lending to businesses or home buyers.
Because nobody wants to borrow. This is the classic liquidity trap, or as Richard Koo would call it, a balance sheet recession. Households are paying down debt, companies are preserving cash, the property sector is still a black hole. We saw that op-ed by David Tingswan saying the property downturn isn't ending anytime soon. The inventory overhang is just massive.
It's the Japanification of China. We've been saying this for a year, but the data is now irrefutable. Low rates, high liquidity injections, but struggling growth. The money multiplier is broken. You can print all the yuan you want, but if the velocity of money is zero, you get deflation.
And amidst this liquidity trap, the tech war continues to get messier and messier. The Pentagon just updated the 1260H list. This is the list of Chinese companies allegedly working with the military.
This was a mess of a rollout. First, they withdraw a list that alleged Alibaba and BYD are aiding the military, which caused a brief pop in those stocks. But then they update the 1260H list with other high-profile companies. It's just regulatory chaos.
It creates an uninvestable environment for institutional capital. If I'm a pension fund manager in California, I can't touch Chinese tech. Not because the company is bad, but because I don't know if the ticker will be illegal to own next Tuesday.
Exactly. You don't know if the stock you own today is going to be sanctioned tomorrow. The risk premium is infinite. The only thing keeping the Asian tech valuations afloat right now is the AI arms race.
Right. We see NVIDIA fighting tooth and nail for users in China, trying to navigate the export controls, creating these cut-down chips.
Yeah.
And look at SoftBank in Tokyo.
SoftBank is the perfect example of this bifurcation. Their profits quintupled. Why? Was it because the Japanese economy is booming? No. Was it because their Chinese investments recovered? No. It was because of their vision fund bet on OpenAI. It's not because the underlying domestic economy is booming. It's because they own a piece of the global AI monopoly. That is the only game in town for growth in North Asia right now.
So let's zoom out. If you are an investor looking at this map, U.S. tariffs creating supply shocks, Middle East war risk spiking oil, Japan going nationalist and threatening the carry trade, China stuck in deflation, where do you put your money? Because the capital is moving, it has to go somewhere. And we are seeing a distinct growth alpha emerging in South and Southeast Asia.
This is the volume divergence I mentioned at the top. While the headlines are in the Middle East, the volume, the real physical investment, is moving to India and ASEAN. Let's start with New Delhi.
The AI summit in New Delhi, I was reading the transcripts from the keynote speeches. The rhetoric there is totally different from the regulatory crackdowns we see in Europe or the trade war posture in the US. The Indian government is framing AI as a strategic national tool. They aren't trying to regulate it to death, they're trying to build national infrastructure around it. They view it like electricity or roads.
And the CapEx confirms it. We aren't just looking at government press releases. I track foreign direct investment, FDI flows, very closely. Look at Mitsui Fudosan, the massive Japanese builder. They're launching a huge condo project in India. Now, Japanese real estate capital is notoriously conservative. They don't take flyers on risky markets. When Mitsui Fudosan breaks ground in India, it means they have done the actuarial math on the next 20 years of Indian urbanization.
That's the signal, isn't it? When the Japanese builders arrive, the long-term growth story is accepted. It's about demographics. India's median age is roughly 28. Japan is 49. China is 39. You are moving capital from aging, shrinking populations to young, consuming populations. And we are seeing top consumer firms in India lifting their outlooks. Urban demand is just surging. This is a physical build-out, story steel, cement, glass.
And it's not just India. Look at the ASEAN numbers. Malaysia just printed GDP growth of 5.2%, expanding in Q4. Indonesia is forecasting up to 6% growth in Q1. These economies are firing on all cylinders.
This is the China plus one benefit in action. We talked about the U.S. finalizing tariffs on graphite from China. If you are a battery manufacturer or an electronics maker and you can't be in China anymore because of tariffs, where do you go? You go south, you go to Malaysia for semiconductors, you go to Indonesia for nickel and battery processing.
And the financial center of gravity is shifting too. This is a subtle but really important data point. Singapore is chasing growth IPOs aggressively. They are actively courting these high-growth Southeast Asian tech firms. Meanwhile, Hong Kong is struggling to attract them because of that geopolitical overhang we discussed. If you want growth without the sanction risk, you go to Singapore or you go to Mumbai.
I want to touch on a frontier market that just popped up on the radar, Bangladesh.
Interesting setup there. The BNP won the election.
Right, and for listeners who don't follow Bangladeshi politics, the BNP platform promises total deregulation. Now, whether they deliver is another question entirely. But the market likes boring and deregulated. If they actually follow through, you have a massive labor pool, 170 million people right next to India, suddenly open for business.
That's a classic turnaround play. If they deregulate, it unlocks a frontier market that has been held back by political instability and bureaucracy. It's risky, highly volatile, but the risk-reward ratio is better there than in a sanctioned Chinese tech stock right now. You're buying the bottom of the curve.
Okay, let's bring this down to the corporate level. The so what for the listeners. We have some specific corporate moves that highlight these macro trends. First up, the SpaceX IPO rumors.
This is the buzz in New York. The structure is the key here. The reports are that they are going to use a dual-class share structure to keep Musk in total control.
It's the founder premium. In a normal market, governance hawks, the ESG crowd, the pension funds would hate that. They would scream about shareholder rights. But for SpaceX, investors will accept zero voting rights just to get access to the monopoly on space transport.
It proves that capital is desperate for true innovation. The scarcity of true alpha assets companies that have a genuine moat is so high that investors will waive all governance rights. It's basically, shut up and take my money.
And then there is the EV shuffle. This is where politics and business really collide. Nissan is polishing its EV capabilities in China, specifically in the frigid north, to prove their battery tech. They are in survival mode. They know if they can't compete in China, they die.
But the bigger signal is Canada. This one really surprised me. Canada is turning to China to revive its EV sector, despite U.S. pressure.
That is a significant breach of the alliance wall, isn't it? Canada is essentially saying, look, Washington, we love you, but our auto sector is dying. We need the battery tech and the investment, and China's the only one offering it. It's economic pragmatism winning out over ideology. It shows that the U.S. containment strategy has leaks. Even close allies like Canada have to prioritize their own industrial survival.
Which brings us to a fascinating, almost philosophical data point to close the segment. A stark contrast to the growth we see in India, Switzerland.
This is wild. Bern is holding a referendum to cap the population at 10 million.
Think about that for a second. A developed, wealthy nation voluntarily saying, we are full, stop the growth. It is the return of the Malthusian debate. They are prioritizing quality of life, open space, and infrastructure load over raw GDP growth.
It stands in such stark contrast to India or Indonesia, where the mantra is growth at all costs. It really highlights the bifurcation of the world. The West is aging, wealthy, capping growth, and trying to protect what it has. The East, specifically the South, is hungry, expanding, and building.
And that is the trade. You cannot trade a global index anymore. The correlations are broken. If you buy the MSCI World Index, you are buying a bag of contradictions. You're buying Swiss caps and Indian booms, U.S. tariffs and Chinese deflation. They cancel each other out.
So let's wrap this up. What is the conviction trade here, if you had to pick one thing to watch this week?
For me, you have to watch the palladium spread and the oil volatility. Those are the canaries in the coal mine. If the 10-year yield continues to drop because of flight to safety, while those commodities spike because of war risk, get defensive, cash is an option. When bonds and commodities diverge that hard, something breaks.
And structurally, you have to be long strategic geography. That means India. That means ASEAN, places that benefit from the fragmentation. And you have to be short, or at least very hedged on, the geopolitical fault lines. Eastern Europe and the Middle East are uninvestable for the faint of heart right now. The risk of a binary event, a tariff, a blockade, a sanction, is just too high.
Trust the data, not the narrative. The narrative says soft landing. The data says supply shock.
History is happening faster than the ticker can update. Stay nimble out there.
Stay ahead of the curve. This is Global Macro Pulse.
Disclaimer, not financial advice.